Warren Buffett's investment success lies in leveraging others' financial expertise, often achieved passively through dividends. His portfolio consistently leans towards banking institutions, an industry he views as perpetual. Opt for the sustainable dividends from Scotia Bank and US Bancorp, currently available at substantial discounts. Warren Buffett has long favored banking institutions and financial service companies, considering banking a sector with enduring prospects. Banks serve as the bedrock for our savings, facilitating transactions, investments, and the fulfillment of our aspirations for homes and cars. Essentially, businesses will always rely on banks to enable growth and conduct operations. During tumultuous periods in the sector, Mr. Buffett seizes the opportunity to invest in quality firms at undervalued prices. For instance, he acquired shares of American Express, AXP, amid a scandal-ridden banking era in the 1960s, and M&T Bank, MTB, during the savings and loan crisis. During times of widespread fear or panic, look for bargain opportunities.
Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys.
Banking sectors often yield generous dividends at reasonable payout ratios, allocating a substantial portion of profits to shareholders while retaining enough for stability. Let's explore two such well-managed banking leaders that have consistently rewarded shareholders with dividends during challenging financial climates. Pick #1, BNS. Yield 7%. Canada boasts the G7's fastest-growing population, and its banking system functions as an oligopoly. The country's Big Five banks, including Scotiabank, BNS, offer similar products and services, maintaining tight coordination on fee adjustments. Newcomers to Canada generally engage one of these financial institutions for their banking needs. Scotiabank, one of Canada's oldest and largest banks, has a rich history of dividend payouts dating back to 1833. It consistently ranks among the world's safest banks, currently at #26 globally, behind Royal Bank of Canada at #10 and Toronto Dominion Bank at #21. Notably, none of the prominent US banks rank within the top 50 in recent evaluations. All figures mentioned in this section are in Canadian dollars. Scotiabank declares dividends in CAD, subjecting US investors to varying amounts based on exchange rates. US investors face a 15% tax withholding on dividends from Canadian corporations. Approximately 74% of Scotiabank's residential mortgages are uninsured, indicating a substantial equity ownership by borrowers and a lower risk profile for the bank. Moreover, the residential mortgage portfolio demonstrates robust credit quality, with over 86% of uninsured loans issued to customers with a credit score of 720 or higher and an overall portfolio average FICO score of 801. Critical to note, the mortgage maturity schedule shows a staggered pattern, with more maturities slated for 2025 and 2026, attributed to the home construction spree in 2020 to 21. With the Bank of Canada nearing the conclusion of its rate hikes and mounting concerns about housing affordability in the current economic climate, a potential rate decrease from mid-next year could ease the burden for homeowners at renewal. Scotiabank's commercial real estate (CRE) portfolio comprises less than 7% in office property loans, with about 2/3 being investment-grade facilities, primarily supporting well-established, diversified entities. At the close of Q3, Scotiabank reported a 9% increase in deposits, a 7% uptick in its loan portfolio, and a Common Equity Tier 1 (CET1) ratio of 12.7%, up from 12.3% in Q2. Similar to trends observed in other banks, Scotiabank's provision for credit losses rose to $819 million from $709 million in the previous quarter and $412 million a year ago. Notably, 94% of the bank's loans are backed by assets, predominantly comprising mortgages, auto loans, and lines of credit. Recently, Scotiabank hiked its quarterly dividend to $1.06 per share, representing a 7% annualized yield. This dividend maintains a modest 58% payout ratio. The bank's senior debt holds A-plus credit ratings from S&P and similar endorsements from leading credit agencies. Amidst market uncertainties, Scotiabank continues fortifying its capital and liquidity metrics while expanding its deposits and loan portfolio. With a track record of navigating challenging conditions, the bank remains well prepared to sustain this trajectory and deliver increasing dividends to its shareholders. Selection #2. U.S. Bancorp's Preferreds, offering up to 8% yields. U.S. Bancorp, USB, stands as the nation's fifth largest bank by total assets, managing a substantial $664 billion in assets under management. Originating in 1863, USB presently operates branches across 26 states. USB has been actively bolstering its capital ratios, showcasing a commendable CET1 ratio of 9.7% and reinforcing its financial standing by injecting an additional $95 million into the loan loss reserve. The bank continues to expand its deposit base, marking a 3% year-on-year growth. Although the effects of monetary tightening have strained its credit quality indicators, these metrics persist at stable levels, remaining below those observed before the pandemic. Within USB's $54.2 billion commercial real estate (CRE) loan portfolio, only 1.3% is classified as non-performing, primarily influenced by the office portfolio's performance. On the residential mortgage front, metrics portray robust health, with borrowers maintaining a weighted average credit score of 771 and a weighted average loan-to-value (LTV) of 72%. As of Q3, there were no non-performing loans within USB's credit card portfolio. Although delinquencies have risen sequentially, these metrics continue to stand well below pre-pandemic levels. Moreover, USB's $46.4 billion retail loan portfolio experienced no significant changes in delinquency rates or non-performance. US Bancorp, USB, has consistently increased its common stock dividend since 2009. While the bank declared a $0 48-share dividend for Q3, investors may have anticipated a moderate yearly raise. However, the bank is currently focused on preserving liquidity. As the Fed's plan becomes clearer, USB will likely resume its trend of increasing the common dividend. Despite not filing its 10Q yet, based on Q3's diluted EPS, the estimated year-to-date payout ratio stands at around 50%. USB remains cautious, prioritizing credit quality optimization, liquidity, and capital levels. The safety of both common and preferred dividends is maintained. With the Fed indicating a prolonged period of higher rates, USBH's floating rate coupon offers sustained elevated income, even in such an environment. In conclusion, dividends are the result of hard work by dedicated professionals in companies where consumers spend their money. We've built a diverse portfolio of over 45 dividend payers, targeting an impressive overall yield of over 9%. Our goal is to support investors in achieving a passive income for a fulfilling retirement, aligning with Warren Buffett's advice of making money while sleeping, granting financial freedom in retirement without being bound to work indefinitely.